Hello and welcome to another episode of our From the Helm series live here at the ASX Midcaps Conference for 2025. I'm Grady Wulff, Senior Market Analyst with Bell Financial Group. Now, a very familiar name in a household of Australia, Cash Converters is an Australian company with being a franchisor, retailer of secondhand goods and financial services, and a provider of secured and unsecured loans. Sam Budiselik, Managing Director and CEO, thank you so much
for having me, Grady. Yeah, great to see you.
I've always wanted to chat about Cash Converters.
Yeah.
For our investors who may not know the Cash Converters story, can you tell us about the company?
Yeah, look, the company started 40 years ago. Wow. It was really a retail buy-sell, pre-owned retail coming in. We'd buy it and sell it to our other customers.
Yeah.
We then sort of started to expand to provide some loans against those goods.
Yeah.
Now we're like a consumer finance business offering personal loans to our part of the market. And that's really people that, I'd say they're non-conforming borrowers. They're people that have had some event on their banking or they've got irregular income.
Yeah.
The people that the banks deem too high risk. And there's a lot. There's probably 3 or 4 million in Australia.
Yeah.
And that's the part of the market we lend into.
And how do you manage the risk on that front? Because obviously banks are very risk averse.
Yeah.
How do you trust or how do you take on a customer going, yep, that's a good one versus bad debt?
Yeah, it's a good question because these customers are quite unique. They might not have a deep credit file. Okay. So we build our own credit score for the customer. So we load bank statements and other information about the customer.
Cool.
Rely on our machine learning models and try to build a profile of the customer.
Yep.
But you find we've got store networks in operation where we can meet the customers directly, which is a bit different to just an online lending business. So we build a relationship, we get to know you. In the local community, our stores are important.
Exactly.
So it's like a bank branch that cares, and the people in our store care about our customers. And it goes a bit deeper than just a credit model. But we do rely on that technology to wash through a lot of the applications and make sure that the credit risk is appropriate.
Yeah, for sure. Now, FY25 showed a pretty resilient year for yourselves, despite some pretty big headwinds for the sector and for retail in particular. Obviously, revenue up 1%, profits rose 41%, gross loan book declined. So this looked pretty good. How did you manage it and what were the key drivers?
Yeah, it's been a big pivot for the business. And I think for us to sustainably grow, we needed to change our lending products, lower the cost, help the customers out with that. And that then opens up some better funding options for our business, which is great. But the retail store network's been really interesting. The luxury inventory move and the trend globally is really starting to pick up.
It is.
We've seen our gross margins improving. We're selling more handbags, watches, jewellery than ever before.
Wow.
And we've just opened that Bondi luxury only store. Actually.
Love
so
it.
Only handbags, jewellery, high-end consumer electronics and watches in that store. That won't be all of our stores, but I think it's showing that we buy a lot of that inventory. We can become known for that as a physical store reseller and buyer. It's quite unique.
It's definitely a good one. In Bondi, everyone loves Bondi for the bag.
Yeah, I'm West Australian, but I believe Bondi is a good spot for it. We might look at Claremont or somewhere like that, right?
It's exactly the same.
Yeah, to keep it local.
Yeah, exactly. Golden Triangle job. Now, what is the target mix of lending products going forward? Loan size, duration, and how do you foresee the gross loan book evolving over the next financial year?
Yeah, look, 10 years ago when I started, we really only had the up to $2,000 loan product, and that's sort of referred to as a payday loan. Publicly, it's a small amount credit contract in the Credit Act. We're not going to have any of that going forward. So we're going sort of $2,000 to $5,000 loans over 12 to 18 months. Gainfully employed people, which is a bit of a shift for the business. So I think our models are such now that we can sort of lower rates and move into a different part of the market, whereas we couldn't before.
So a little bit less risk?
Less risk. Take our customers on a journey. The good customers that we know we can help. The new customers that we're winning are a little bit different than they were in the past. So that book will grow. There's big demand. I mean, we're getting 40, 50,000 loan applications a month into our business for personal loans. So if we can get the product right and meet that demand, I think it'll be good loan book growth we'll see. In the right way.
And so as you are growing this new lending products and kind of diversifying into the market, how are you managing the risks and rising net loss? For customers, obviously.
Our business has become about data science and technology and credit models. And I think, 10 years ago, we were manually risking bank applications, loan applications.
One of the days of pen and paper.
Now it's really tech-based. So the bank statements for us tell a story and we can load them and sort of get a position on a customer. all of our loan approvals are manually approved. So we've always got an assessor, double checking what the computer says, if you like, just making sure the application's complete and accurate. Have a chat to the customer, does it meet your needs? And that's how we operate. It's a bit different to another lender. Yeah.
Does AI play a role in moving forward and machine learning?
Yeah, machine learning is important on the lending business. That's really enabled us to offer innovate new loan products and lower loss rates and leave everyone better off.
Yeah.
When you think about our volumes, we've got to be efficient at sort of sifting through.
You've got to be quick as well.
Yeah. AI on the retail, the inventory side's interesting. We can sort of have a handbag come in, take 20 high definition photos and authenticate the handbag as a fake or genuine.
Wow.
Yeah, so that's really moved what we can buy.
Yeah.
We can underwrite those products and authenticate them for our customers.
Is that instantaneous?
It
take
is.
The photos and it goes fake real?
It is, yeah.
Wow.
Stitching, brand, badges, serial numbers, and it's read back to a database and it's authenticated.
That is fantastic.
Yeah, it's a really exciting development.
It really enhances your ability to deliver.
Yeah, and change our inventory mix.
Yeah, exactly.
If you can imagine you're buying things and you don't know what's going to come into a store, if it's a handbag and you've never seen one, and if it's a watch and you're not aware of them, it helps overcome that. So.
That's fantastic. Yeah. Now, obviously, with what metrics and success criteria are you looking for this new luxury store format? Because as you mentioned, and as we've seen in the market, this luxury spend is back.
Yeah, it really is. I think we can offer smaller store footprints with this higher value inventory. Okay. So hence we can open inner city locations that we haven't been in before.
Yeah.
And then I think we just reach a different sort of customer set.
Okay. Yeah.
But we'll make sure that the luxury inventory might be slightly lower gross margin, but higher turnover.
Yeah.
Less staff, lower leasing. The model, the commercial sort of the unit economics around that are quite different to the big sort of suburban store.
Yeah, like an Innaloo in Perth. There
you go. Exactly.
Every day,
good local knowledge.
Exactly.
Yeah.
Now, with franchise store acquisitions in Australia, the UK, Europe, you're obviously expanding globally and contributing to the bottom line. What is the plan for balancing growth via acquisitions versus natural and organic growth?
Yeah, I think having acquired some stores, we're now isolating our comp store performance, a traditional network, how are we growing sort of, organically.
Yeah.
And the acquired store network starting to grow. So we're sort of breaking that out as the inorganic growth lever that we've got. We've got 60 franchise stores in Oz still to buy and about 130 in the UK. So there's still a big network of franchise stores to buy.
So you're buying them all back?
We're buying them back,
to keep them under the umbrella.
Get them in under the corporate umbrella.
Yeah, awesome.
I think as a consumer finance business, a corporate network lends better to dealing with customers when you're loaning money and the business model's changed a bit.
Yeah, and you keep central control.
Yeah. And the franchisees were great for growing the network, and now we're corporatizing.
Yeah, it's not often that you see a franchises be bought back, so it is a very interesting move, a really smart and strategic move.
Yeah.
Now, what levers do you think will be the biggest drivers of margin improvement in FY26?
Yeah, I think we'll see loan book growth at a much lower loss rate.
Yeah.
So that's the key thing. I think everybody ends up, you're pedaling less hard under the water to get a better outcome for everyone. Yeah. So that's a key lever. And I think ongoing acquisitions, folding these earnings accretive acquisitions in, will keep that growing as well. So two big growth drivers there, Australia and the UK really being the short-term focus.
With improved earnings, stronger cash positions, what's your policy around dividends? Obviously, investors like to hear some coming back to them.
Yeah, or being a small or maybe mid-cap now or in the all ordinaries.
You're a bit bigger now.
Look, we're roughly paying out 50% of our net profit. And I think we'll sort of hold around that.
It's a great policy.
Yeah, and we've paid 5 years of 2 cent fully franked dividends. So we're a small cap that pays a dividend. We've got good free cash. Yeah, sustainably doing that.
Yeah.
And then our free cash is going towards acquiring stores. So a bit of a dividend and a bit more growth. And good combination, hopefully.
Absolutely. Now, what can investors expect on a news flow front over the next 12 months from Cash Converters?
Well, we're about to launch our new Cashies loan product. So we sponsor the AFL. We're coming out with the Cashies loan. Yeah, I think it'll create a bit of buzz, really get a good social and online and above the line marketing campaign going, build that new loan book. And store acquisitions. I'd love to be announcing, the biggest store networks over here that are in that 60 that we're still buying, particularly on the eastern seaboard where, we've only got, I think, 24 stores in New South Wales. We should have a lot more.
You should have way more than that over here.
Yeah. So, wandering over here is exciting too. So definitely in growth mode.
Sam, thank you so much for joining us.
Thank you for having me.
And thanks for listening to this episode of Cash Converters. I'm from the helm here at the ASX Mid-Cap Conference for 2025. I'm Grady Wulff. I really hope you enjoyed that episode as much as we did filming it. If you did, be sure to subscribe to our YouTube channels to stay up to date with all analysis, market commentary, insights, and of course, exclusive CEO interviews.
Thanks for having us.